Okay, surprise today. We have another Bank of Canada meeting, and you're going to see tons of videos, obviously, around the internet on this type of thing. Now, what does these things really mean? So, we have two things that are very important. I've pulled this Globe and Mail article just to speak about it. So, Bank of Canada ends quantitative easing program, moves forward timeline for rate hikes. So, first of all, I think this is going to seem like contrary advice to what we usually talk about, but what does that mean as far as um, what does that mean as far as a situation where you have a variable rate? So let's just get this out of the way. I think we can be very clear that eventually your variable rate is going to go up. And the Bank of Canada is moving up that timeline, and this may seem really terrifying, but let's just break down some numbers here. So really, if you have a variable rate today, a little bit of discrepancy rate, but you could be at prime minus 1.1. So prime minus 1.1 would give you a 1.35. The Bank of Canada says now they expect that they could move up that situation. They could move it up by a full percentage point. So that'd move you up to 2.35. So this is the draconian situation that you could end up at 2.35. So first of all, know this. A fixed rate would be about 2.35 today. So, basically the risk right now in going variable over fixed is that you could take the fixed rate that you're going to get on a variable rate eventually. So a little bit of a silly logic there, but let's really break some numbers down here. So if I borrow $500,000, that means that I'm going to have a payment right now on a variable rate of $1,963. And if that rate goes up a whole percent, I'm going to go up to a payment of $2,202. And so that means that my risk right now is that there's a $240 difference. $240 difference. So the most draconian situation, a $5,000 mortgage is a $240 difference. Now, during this whole situation, so let's just go with the premises that I think it's likely that variables go up, is that it does mean that you're going to have all this opportunity that we could look at locking in. I don't know that we're going to recommend it, but all these opportunities where we can look at locking in before that happens. They're not going to happen instantaneously. We're talking about small chunks every single time. We can make a decision at each interval and locking into a fixed rate. So that's super, super important to know. That's and this article talks about it. That they could start raising rates sometimes in the middle quarters of 2022. So, we're still recommending variable on a number of reasons. First of all, by going fixed, you're going to have a similar rate on what you're going to end up with. Secondly, you can see the payment shock is not that meaningful. You can actually move up your payment to that point right now to get used to that. And so that means that the payment will not actually go up. Have all everything going towards principal, that would be a very savvy move as well. The third thing, and we cannot understate this fact, is that you will, the interest rate differential, which means you pay up the mortgage early because you sell, you get divorced, you refinance, you renovate, anything, life happens, is still 5 times greater on a fixed rate or a variable rate. Even if we have the fixed and variable rate as identical numbers, we're always going to recommend a variable rate in the sense that the interest rate differential is going to cost you a lot of money. And so even if we break that down and say, okay, let's say we think these numbers are wrong. Let's say we think that we're going to have the Bank of Canada prime rate go up by 200 basis points, which would be 2 points, 2%, which means that you would have a meaningful. So let's say that's $480 you're paying extra per month. Well, let's just round that up to $500 a month, which means that you're going to spend $6,000 extra per year. That $6,000 is still that's $6,000 per year. Means that you still have to have, if you pay out your mortgage early, you would still, even if the rate doubled over this number, you would still have to have an interest rate. You would still have to not pay your mortgage out the entire term, because even if you're anywhere less than, if you pay an interest rate differential of anywhere in the neighborhood of $18,000, which is going to be 3 years of interest, you're going to lose all that anyway. So even if we were talking about prime going from what you paying going interest rate to 3.35, we could probably still meaningful recommend the variable. So anyway, stay variable. Those are some recommendations around that. Obviously, the choice is yours. You could still have to go fixed. As far as quantitative easing, just to put this in layman's terms, this means that they are going to not continue to print money at this point, which could have or will inevitably have some impact on inflation. But that's a much bigger conversation right now. What you need to know is that the government has been continually creating more money every single month, which is what's causing the price of a whole bunch of things, houses, vehicles, to go up from that perspective. Anyway, if you have any questions, well, please do reach out to us for an appointment. Go ahead and like this video if you can, and we'd love it if you share it and subscribe to our channel. Thanks so much and have a great day.